Hey, it's Patti Scharf, CPA and co-founder of Catching Clouds, the leader in e-commerce accounting. And today we're going to talk about different business entity types. Now, before I get started, I want to give you a disclaimer. I am not an attorney. I don't even do taxes anymore, but I do know a little bit about this information. So, disclaimer. So one of the questions I hear all the time is, which is better, an LLC or an S corporation? And this question actually drives me crazy because it tells me that there's a fundamental misunderstanding out there about how to think of business entity types. There are actually two different structures. One is a legal structure and one is a tax structure. And the legal structure will cover things like a sole proprietor, a partnership, a limited liability company, and a corporation. You'll notice that an S corporation isn't even in that list. That's because that's a tax designation. So let's get started and talk about the different entity types. Okay, sole proprietor. So sole proprietor is one of the easiest ones to understand. It's the easiest one to set up because basically you're just like, hey, I am now a business, and poof, you're a sole proprietor. So you don't have to necessarily file anything. You don't have to really do anything to be a sole proprietor. You have no paperwork. You don't have to register with the Secretary of State. However, if you have, let's say you are Joe and you're starting up Joe's Fish Shop, and you want to use the name Joe's Fish Shop, you will go to your Secretary of State and you will register a trade name for that. But that doesn't create an actual legal entity, and there's no liability protection in being a sole proprietor. The default tax treatment for a sole proprietor is going to be filing your business information on Schedule C on your Form 1040, which is your personal income tax return. You're going to pay federal income tax, you're going to pay state income tax, and you're also going to pay self-employment tax. That is 15.3%. You get to take half of that as a deduction on your taxes, but in any case, it's kind of an expensive way to do business and there's no liability protection. So if you're in a line of business that's low risk, you might do it. If you're really, really small, you might do it. If one of my kids was going to have a little business doing tutoring or something like that, babysitting, that they're just going to get a little bit of money for, they would be a sole proprietor. But other than that, a lot of people stay away from that business type just because the lack of liability protection and the fact that there aren't a lot of tax breaks doing that. Okay, the next entity type is partnerships. And I'm going to kind of gloss over this just a little bit. I'll give you kind of the basics, but since there are so many different types of partnerships, there's not really one size fits all that I can tell you about on this video without like making it really long. So partnerships is basically, it's kind of like a sole proprietorship but you have more than one person. So you have two people who get together and say, I will now be a partnership. They do have some paperwork that they can file a partnership agreement and things like that and register with the state. One of the kind of crummy things about partnerships is it's really kind of hard to divvy up authority, and I hear just all these horror stories about people who go into partnership together and then it's a nightmare untangling themselves from the partnership. So I'd say be careful with the partnership. It's very flexible. You can do a lot of things with it, but it can also be kind of a hassle getting out of it. They do have their own business return that they file. It's Form 1065. And what that does is it kind of gathers all the information for the business and it says, here's your income, here are your expenses, here's the net amount that you made, and then it divvies it up between all the different partners. So each person gets their share of the income that's reported on their personal tax return. Those are reported on Schedule K1. They take that over to their personal tax return, put the information on there, and they all pay the income at the tax on the income at their own personal income tax rate based on whatever their finances look like. So they also pay self-employment tax generally speaking, for this partnership income. The next entity type is limited liability company. Now you'll notice I didn't say limited liability corporation. That's just something that like raises the hair on the back of my neck up, because it's not a corporation. That's a different entity type. It's a limited liability company. And what this is you can have one person, you can have many people. They are called members. Those are the owners of the limited liability company. And the reason why a lot of people like LLCs is because they're just so easy to set up. Like literally in Colorado, you go online and you say, this is the name of my company. You attach your articles of organization, which is not a lot of information, like name and address and that sort of thing, not tons of information. And you pay $50 and boom, you're an LLC. So it's really flexible. You don't have to deal with some of the things that corporations have to deal with, which I'll talk about in a minute. There just aren't a lot of hoops to jump over. You will need an operating agreement that kind of just lays out who's in charge of what operationally, how you're going to run your business and that sort of thing. But you don't need lots of red tape and regulation. There's not a lot that you really have to worry about for that. The LLC does give you some liability protection. I would say, but before I say that, I want to say that you have to treat your business as a business separate from your personal. If you're commingling all your funds, then you're probably not going to get that liability protection that you're looking for. So if you go to the trouble of setting up an LLC, make sure that you're treating it as its own entity and not commingling funds and sharing bank accounts and credit cards and making it really confusing. The default tax treatment for the LLC depends on how many people are members of the LLC. So if it's a single member LLC, which not all states allow, but like in Colorado they do, and if you have a single member LLC, then the default treatment is to be what's called a disregarded entity, basically just like a sole proprietorship, where the IRS and the government just kind of go, what? I don't see you as a company, and they let you file your taxes on Schedule C on your 1040. So it just kind of pretends that the company's not there. If you have two or more members of the LLC, the default treatment is a partnership return. So again, you file your partnership return, the information gets sent out to the different people as far as how much of that income relates to you personally, and you file that on your personal tax returns. That's called a flow-through entity, okay? Okay, the last entity type I'm going to talk about is a corporation. Now you'll notice I didn't say S corporation or C corporation. That's because those are tax distinctions. That's how they are taxed. It doesn't have anything to do with the legal formation of the corporation itself. So a corporation is the most administratively burdensome entity that there is. It's got lots of red tape. It's got lots of different things you got to keep track of. And you typically have, well, you always have shareholders. So those are the owners of the company. Whoever has shares of stock in this corporation, they are the shareholders of the company. You've got the board of directors who oversees everything and make sure that everything is going according to plan. And then you've got the officers who are kind of more boots on the ground, making sure that everything's getting done operationally that needs to be taken care of. There's also a lot of paperwork that has to do with the corporation. You have to have minutes, you have to have bylaws, you have to have shareholders agreements if you've got more than one shareholder. You've got articles of incorporation. So a limited liability company would have articles of organization. The corporation would have articles of incorporation. One of the good things about a corporation is there's a lot of legal liability protection with the corporation. It's easy to transfer ownership because when you have shares of stock, you just sell the stock and then you buy the stock, and it's just easily transferable. And that's one of the big reasons why a lot of people use it. And it's easy to raise capital, kind of for that same reason, because it's really easy for people to invest in a corporation. Now, I would be remiss if I did not talk about the C corporation and S corporation, so let's talk about the tax designations, differences between the two. For a C corporation, this is one of the things that a lot of people complain about when they talk about double taxation. So if you're filing your tax returns as a C corporation, then you are filing Form 1120. And what happens is they take the income and then the deductible expenses, you get your net income, and then that net income with adjustments or whatever, becomes your taxable income. That taxable income is taxed at the corporate rate. So unlike these other ones that I was talking about that all flow through to the personal tax returns, that doesn't happen here. It actually gets the corporation itself actually gets taxed. But the owners of the corporation, if you are working for the company and you're getting a paycheck, you're any of the money that you're pulling out of the business as wages, that gets taxed on your personal tax return, and any dividends that get distributed from the company gets taxed at the dividends rate on your personal tax return. So that's why they call it double taxation, because the corporation gets taxed and the individual gets taxed. Okay, so let's talk about S corporations. S corporations, people talk about these all the time. You see lots of people who are, hey, you need to be an S corp. Let me tell you why. It's because it's treated more like a partnership in the sense that you're not getting double taxed. The company itself doesn't have to pay tax. The income that flows through goes to the owner of the business, and they pay tax on that, but they don't have to pay self-employment tax on that. So if you've got $100,000 and you've got one company that's being taxed as, say, a partnership, and they're paying 15.3% of self-employment tax, and you've got this other company that's paying 0 in self-employment tax, yay, the S corporation is way more advantageous. However, the S corporation, one of the rules of being an S corporation is that you have to pay yourself a reasonable salary for working in the business. So if you make $100,000 and your wages are $100,000, it actually ends up being a wash. So it kind of depends on your personal tax situation, and this is why you need to go see a tax professional. So I hope this helped. If you like this video, please like it, share it, comment. If you haven't already, please subscribe, and I'll catch you later.